And as you know, we've been asking our committee members for their best contrarian plays for this new year. We continue that today. Josh Brown, yours is what?
Let's do K-Web. So basically, since inception, this thing has had a hell of a round trip, and it's no secret the entire Chinese stock market is down 60% over the past 2 years. You cannot find somebody who will tell you they believe Chinese stocks are investable. And that is, if you're talking about like a big contrarian swing, this is probably the biggest contrarian swing that you could take. The top 10 holdings in K-Web, which is the Crane Shares Chinese Internet ETF, Baba, Tencent, PDD, Meituan, NetEase, JD, you know the names, Baidu, Trip.com. They're in all different sectors of the Chinese economy. There are multiple problems here with China. We're all familiar with government crackdowns against large tech platforms. We're all familiar with some of the issues they've had reopening from COVID. We all know that there's an icy relationship between China and the West. So if you think that this can never get better, then the huge discount that these names are selling for is a valid discount and should remain in place. However, if you think that things are so bad that there probably is room for improvement on the sentiment front, these stocks are too cheap to ignore, and that valuation gap should close. K-Web is 72% below its all-time highs. It's had massive rallies over the last 10 years. It could again. I don't know what the catalyst would be. I'm not positioning myself as a geopolitical expert on U.S.-China relations. I'm just telling you, you want contrarian, this is contrarian.
Okay, Shan, you want people to bet on commodities. That's your contrarian play. Why?
Well, it's so interesting. Normally, I would come on here and we'd be talking about expectations for a booming economy or meaningful supply shocks or both if you're talking about commodities. But we actually look at this in terms of a hedge potentially for 2024, a hedge against some pockets of surprise inflation, a hedge against some of those geopolitical concerns that Josh just mentioned, and frankly, a hedge against stronger Chinese growth. And so it's really interesting because I view this, if you look at last year, Scott, you look at all of the selling of Chinese equities. A lot of the emerging markets flows went into anything that was ex-China on the EM side. And so rather than having to take that explicit exposure in Chinese stocks, we view commodities as a potential hedge. The flip side of this is we could actually see some improvement in manufacturing here in the U.S. We're still technically in recessionary territory on the PMI. So either way, on the flip side of this, industrial metals, precious metals, energy, perhaps not as much on the ag side, but we do think there's some opportunities here as a hedge.
Okay, good stuff. All right, Carrie. The third highest short interest stock in the S&P 500, and one that Piper today on a list said to avoid. Is what?
Well, I hadn't seen that. It's CarMax.
And you?
It's my name,
have a pretty big position, and that's your contrarian play. Why?
Yeah, well, we said outside the box, and I guess it is. So here's the deal. You know, the used car market was terrible in the last year, and the stock was also pretty bad and very bad in 2022. But we read, in fact, today that the new car market is picking up. It was better in 2023. New car prices have come down. I mean, we watched all those price cuts from Tesla, but that's true from other manufacturers as well. This is good for used cars because when people buy a new car, they sell their current car, and that goes into inventory at a place like CarMax. So we think that the inventory numbers will pick up, the number of cars they sell will pick up. Interest rates coming down mean that buyers don't have to spend as much on financing costs. This is a company that earned $7 a share a couple of years ago. This year, the number is about $3.50. We think they can get back to $6.50 or $7 in the next couple of years. So this is a stock we think is, an unusual pick, lots of short interest, but short squeezes do one thing. They can push up the price of stocks too.
Okay, lastly, Jimmy, your big bet or one that you think people should take a contrarian play on is what?
Utilities. Now, think about
Exciting.
this. Yeah, no, that's
Whoa.
exactly the
Yay.
point. It's not exciting, right? I do think, and I know it's trite at the beginning of the year to say something like it's going to be a volatile year, but we all know the things that are facing the market: elections, military conflicts, lagged effects of the Fed. I think this is going to be a barn burner of a year in the markets in terms of volatility, and I think there will be points in time where utilities are regarded as a safe play. I don't think, and by the way, they did terribly. We know that last year.
Well, yields were up. No, I mean,
Yields-
this plays into your story from inflation coming down.
Exactly.
Right?
It does, and yields coming down as well. But you don't have to do this in such a boring way. You don't have to go out and buy Con Ed. You can do this by, if you want to take a flyer on something like NextEra Energy, or the utility I own, Pacific Gas and Electric out in California, is coming back from those bankruptcies a few years ago. Very exciting CEO there who gets things done. That's one I like, and it's more than just utilities. There's a story there.